Oh shit, I remember sitting at my kitchen table last night watching this fascinating video over on George Kamel's YouTube channel, and it is a little bit of an older video, so it already has well over 1 million views on it. But hey, let us give it a few more views today because the knowledge inside is absolutely life-altering. And on this specific video, George had the infamous Caleb Hammer as a special guest on his show. And I am sure you already know both of these prominent gentlemen incredibly well if you spend any time at all browsing through the YouTube personal finance space. Now, the entire structural premise of this specific video is actually pretty damn fun. It is a rapid-fire agree or disagree format. They basically go back and forth across the table, aggressively challenging each other's unique financial perspectives, and kind of pressure testing different real-world economic situations. Because the raw truth is that when it comes to personal finance, there really isn't one single universally right answer for every single human being on the planet. Sometimes you completely agree with a strategy, sometimes you violently disagree, and sometimes the actual honest answer is, hey, it totally depends on the context. And toward the absolute end of their conversation, Caleb looks straight at George and poses this exact question. He says, do you agree or disagree that a 7% withdrawal rate is safe for a retiree? And if I could physically jump into the screen right there for a second, I would be the loud person standing in the very back of the room raising my hand high and saying, sometimes, it completely depends on your exact scenario. And George immediately fires back and asks, well, what specific situation could possibly make a massive 7% withdrawal rate safe? And Caleb responds in his classic style, saying, look, if you have a massive $7 million saved up, you get to comfortably take out $490,000 every single year. But George pushes back on the math, saying, here is the real-world thing. Am I really going to force myself to take out a crazy $493,000 every single year just because a rule tells me to? And Caleb says, well, if you are strictly following the textbook rule, you are. But George makes a great point, saying, on an actual human expense level, my real-world living expenses are simply not going to be a massive $490,000 a year, no matter what. Now, here is what is intensely interesting to me about that specific interaction. If you scroll down into the wild comment section of that video, the exact moment those guys mention a 7% safe withdrawal rate, people completely lose their minds. Man, the comment section turns into an absolute war zone. And honestly, I fully get it. I get it because this core mathematical idea of a safe withdrawal rate is easily one of the most talked about, debated concepts in the entire realm of retirement planning. But the tragedy is that it is also simultaneously one of the most heavily misunderstood, misapplied, and honestly oversimplified concepts in the entire financial world. And this is the exact reason why I absolutely love talking about it on this channel, because ultimately, this isn't just about boring math formulas. This is truly about how real human beings end up living their actual lives in retirement. Peace here is what I deeply care about at the end of the day. I want you to go into your retirement years and feel completely confident and free about how you spend the wealth you have worked an entire lifetime to actively build. On the one hand, I obviously do not want you going out and spending your money so aggressively and recklessly that you completely run out of cash in your 70s or 80s. But on the flip side, I also do not want you restricting your lifestyle so severely that you don't end up actually enjoying your retirement or living your life to the absolute fullest. In my mind, both of those extreme scenarios represent an absolute failure of financial planning. First and foremost, to understand this clearly, we need to talk about where this rigid idea even comes from in the first place. This deep-seated cultural belief that you can only safely take a maximum of 4% from a portfolio and be safe from poverty. But often, how this rule is commonly understood by the public today is not at all how it was originally intended by the man who created it. The famous 4% rule comes directly from the pioneering academic research done by a financial planner named William Bengen back in the 1990s. And here is the massive critical key that everyone misses. Bengen's research was never meant to be representative of the average or the typical retirement outcome for investors. And it was absolutely never intended to be this holy commandment or rigid rule that every single retiree should strictly spend this exact amount. Instead, his simulation was designed to answer one very specific extreme question. What is the absolute highest possible withdrawal rate that would have never failed, even in the single worst possible historical retirement scenario we have ever seen in the data? That is it. That is the entire underlying premise of the 4% rule. That is precisely why, when the original research first came out, the baseline number was calculated around 4%. It was later revised slightly upward to about 4.5%. And these days, using expanded modern asset class data, it has been upped once again to about 4.7%. So this baseline range of 4% to 4.7% is really just the worst-case maximum security-safe rate for a total economic disaster. But here's the exciting part that most mainstream financial advisors completely refuse to talk about with their clients. William Bengen himself has explicitly stated on the record that the vast majority of real-world retirees could have easily and safely spent significantly more than 4% of their money. In fact, if you look at the historical numbers, roughly 9% plus of all historical 30-year retirement scenarios fully supported a much higher withdrawal rate, and the typical median real-world experience for investors was meaningfully higher than 4%. So what does that 4% number actually represent in reality? It represents one specific, incredibly unlucky person who retired into the absolute worst, most toxic market sequence in modern history. Think about the extremely unlucky cohort who retired in the late 1960s, or the very early 1970s, right when the United States stock market crashed violently, when historic hyperinflation was raging through the economy and economic growth was completely stagnant. And in Bengen's simulation, this hypothetical retiree still stubbornly took their inflation, adjusted withdrawal every single year for 30 years straight, without ever once adjusting their spending down. Absolutely no guardrails. No behavioral flexibility, just rigid blind withdrawals through the most brutal economic sequence we have ever witnessed. That extreme nightmare scenario is what 4% is built to protect you against. So when you hear generic internet gurus say you should just blindly take 4% out, that is not at all what the actual research concluded. What the research actually proved was that if you happen to retire into the single worst retirement start date in modern history, this is the rock-bottom baseline rate that would have allowed you to barely survive. That is a completely different statement, because we are not saying 4% is absolutely what you should spend. We are saying 4% is simply what successfully survived the absolute worst-case scenario ever recorded. This tells us that the 4% rule was really built around an extreme anomaly, not the typical retirement experience. But I do fully understand why everyday people anchor so incredibly heavily to that 4% number. Because one of the deepest, most primal fears we have as humans is running out of money and being broke in old age. So if 4% represents the absolute historic worst case scenario, what about everything else in between? What about the average person who didn't retire at the absolute worst possible minute in human history, but they also didn't retire at the absolute best bull market minute either? Let us zoom out together and look back at William Bengen's comprehensive research, looking at 30-year rolling retirement periods. The typical, or what we might call the median, like historical experience for a retiree, was meaningfully higher than 4%. In fact, the vast majority of historical retirements easily supported a withdrawal rate closer to about 0% or 7%. And in certain highly favorable cases, especially for those incredibly lucky retirements that started right before a massive secular bull market run, we saw that historical portfolios could easily support double-digit withdrawals for the entire 30-year period without going to zero. Now, let us be very clear and precise on what this data means for your money. Because when we state that the typical historical experience could have supported a 6% or a 7% withdrawal rate, we are absolutely not saying that 6% to 7% is universally safe for everyone under all conditions, or that everyone should go out tomorrow and blindly spend at this elevated level. That is definitely not the takeaway I want you to have. What we are saying is this plain fact. If you look objectively across the full mathematical distribution of retirement outcomes across all historical 30-year periods, most retirees simply did not experience a worst-case economic nightmare, and therefore most retirees could have safely supported a withdrawal rate significantly higher than the standard 4%. So now we can start to visualize a realistic spectrum for our wealth. On the one hand, we have about 4%, which is the survival rate for the absolute worst-case scenario. In the middle of the spectrum, we have about 6% to 7%, which is what many average retirements could have actually supported in reality. And then on the far end, we see even higher rates in exceptionally strong market environments. And this is exactly where things start to get intensely interesting for us, because now the real question becomes, where am I personally going to fall on that spectrum when I decide to clock out? Let us take a moment to really try to bring this abstract concept to life with some real data. It is one thing to talk about academic averages and statistical ranges on a chart, but it is an entirely different experience to truly see how dramatic the change can be based solely on the year you retire. Let us go way back in the data. Because there were a few clustered time periods in history that were just exceptionally, blindingly strong for investors. Periods like 1922 to 1950, 1920, 3 to 1953, or 1920, 4 to 1954. These are the elite historical cohorts of wealth. Sustainable safe withdrawal rates for retirees during these specific windows would have ranged from an incredible 9% all the way up to 11%. So why did this work so beautifully? Simple, because the portfolios caught massive explosive growth in the very early years of the retirement. This early growth built up a massive financial cushion, a psychological buffer which easily allowed the portfolio to absorb any later economic downturns or recessions down the road. Now, let us look at a really solid middle-of-the-road example that looks a lot more like a typical lifetime. Let us say somebody retired in the year 1995, and their 30-year retirement timeline ran all the way through the year split 2020. In this scenario, the investor experienced huge explosive gains early on in the late 1990s tech boom. Then, they had to sit through the brutal dot-com crash, followed by a subsequent recovery, then the catastrophic 2008 global financial crisis, and finally a very strong secular bull market in the 2010s. The sustainable safe withdrawal rate on that specific portfolio would have clocked in right around 6% to 7%. This definitely wasn't a perfect timing situation by any means, and this specific retiree did experience major booms and terrifying market crashes along the way. But this is highly representative of a typical, normal retirement journey, and this portfolio could have easily supported withdrawals that were far and away above the restrictive 4% rule. Now, let us look at an even stronger historical scenario, the retirement period starting in 1982 and running through the year 2012. This specific window marked the absolute starting point of one of the single greatest, most legendary secular bull runs in stock market history. Retirees during this time benefited from decades of consistently falling interest rates and incredibly strong equity returns year after year. The sustainable safe withdrawal rate on this specific portfolio would have been a massive 8% to 9%. This is the lucky retiree who probably looks back today and says, "Man, I honestly don't understand why everyone thinks retirement planning is so incredibly hard." Because for them, the macro market did all the heavy lifting early on, and they simply retired into a wonderful, golden macroeconomic situation. Let us look one more great historical period going from 1975 through the year 2005. This specific retiree entered the market right after a major bloody market crash had already occurred, meaning stock valuations were incredibly cheap. And then they rode a massive, historic bull market through the entirety of the 1980s and 1990s. The sustainable safe withdrawal rate on this portfolio would have been in the comfortable range of about 7% to 8%. This investor would have been able to pull a full 7% from their portfolio on day one, adjust that dollar amount every single year for inflation, and still not run out of money for 30 years straight. Now, let us pause right here and do a mind-bending mental experiment. Let us take that exact same timeline and shift it backward by just 2 tiny years. This is where things get absolutely wild, and it shows you the brutal reality of the financial system. Let us say we have the exact same retiree, and they had a rock-solid $1 million portfolio saved up. But rather than retiring in the wonderful year of 1975, they decided to retire 2 years earlier with their $1 million portfolio in the year 1973. Now, I fully understand from an economist perspective that $1 million in 1973 would not be the exact same purchasing power as $1 million in 1975. These are not perfect apples to apples comparisons because the market would have fluctuated wildly during those 2 years. But for simplicity's sake in this illustration, we are going to say that at both starting points, the investor has $1 million portfolio. So now our retirement period runs from 1973 through the year 2003. What exactly happened to this poor investor immediately after they retired in 1970? They walked face first into an extreme historic bear market. The stock market plummeted about 45% in a short period of time. At the exact same time, historic hyperinflation ripped through the 1970s economy, causing real corporate returns to be incredibly weak for much of that entire decade. This scenario is the absolute textbook definition of sequence of returns risk. Peace. The markets dropped massively early on, right at the start of retirement, while you are actively forcing yourself to draw large chunks of cash from your shrinking portfolio to live on. And to make matters worse, That high inflation is aggressively pushing your required dollar withdrawal higher and higher every single year just to maintain the same basic standard of living. The actual safe withdrawal rate on this 1973 portfolio would have dropped all the way into the ballpark of 4% to 4.2%, which puts this specific scenario firmly in the absolute worst case historic territory. Now, let us look at the real-life human impact of this data, because the actual lives that these two different portfolios could support couldn't possibly have been more different. If you retired in the unlucky year of 1973 with a $1 million portfolio using a strict conservative 4% withdrawal rate, you would be able to pull a modest $40,000 per year to live on. But if you retired just 2 years later in 1975 with that exact same $1 million portfolio balance, and you intelligently opted for a 7% withdrawal rate because the market conditions were prime, that would have given you a massive $70,000 per year. Let that absolute contrast sink deep into your mind for a second. That is nearly double the annual income generated from the exact same size portfolio. The only difference in the world was pure, unadulterated timing. What all of these historical examples clearly prove to us is this core truth. The specific market environment you happen to retire into matters a hell of a lot. This also shows us exactly what the 4% rule was actually built for by William Bengen. It was built specifically to survive the nightmare of 1973. It was absolutely not built for the opportunistic reality of 1975. But here is the major terrifying problem for everyday investors. You do not get to choose what market environment you retire into. Now, do we as economists know what specific macro factors tend to support those highly lucrative, higher withdrawal rate environments? Yes, absolutely. The exact same two compounding factors seem to show up again and again in the historical data factor. Number one is strong, positive investment returns in the very early years of your retirement. If you retire into a raging bull market, your total portfolio balance grows significantly before your lifestyle withdrawals have any statistical chance to do any real damage to the principal. You are naturally building in a massive capital buffer. And factor number two is the total absence of front-loaded inflation. You want to make sure you are not hit with high inflation right away or early on in your retirement timeline. Because if inflation is low early on, you do not have to aggressively ramp up your total dollar withdrawals early on in the compounding process. And when those two wonderful macro factors happen to line up together, that is the exact sweet spot where you see 6%, 7%, or even 8% plus withdrawal rates become completely sustainable for the long term. But here is the ultimate catch. We can only truly know that after the fact, once you have already retired and the future market sequence actually unfolds before your eyes. And this deep, inherent uncertainty is the exact reason why so many everyday people cling so incredibly tightly to the 4% rule. Like a security blanket, they say to themselves, hey, this default rate has successfully survived the absolute worst-case scenario in history. So this is the safe number I am going to stick with, no matter what. And honestly, I fully understand why that is the case for most people. But I am here to tell you that we do not have to live our lives in fear. But please hear me clearly when I say this. I am absolutely not saying that everyone watching this should immediately go out and start taking a massive 4% of their portfolio. But this is also definitely not me saying that everyone should instantly go out and start pulling a 7% withdrawal rate either. The real question you need to be asking yourself is, what should I do right now given my specific personal situation? And the smart answer is to focus on creating a dynamic retirement strategy rather than blindly following a single static rule. So here's how you can intelligently utilize a range. You want to reference the historical data rules and build a custom structure that works for your specific life. Step number one of the strategy is to always start your planning with a flexible range, not a single rigid rate. Maybe you frame your retirement plan like this. If you are someone who is naturally very risk-averse and you do not want to ever consider making lifestyle adjustments, and you want 0% chance of failure, maybe you start your plan in the conservative range of 3.5% to 4%. If you consider yourself more of a balanced investor or you think you are a typical retiree, maybe you look at a highly realistic range of 5% to staggering to 5%. And if you are completely willing to introduce real-world flexibility into your lifestyle, and you possess a higher personal risk tolerance, maybe you start your retirement journey in the lucrative range of